Coming soon, SpaceX and a whole raft of AI companies are going public. So what does that mean now?
So appetite's going to be pretty big.
If SpaceX is trading at a north of $1 trillion valuation, it's going to be in the NASDAQ within about 30 days.
Certainly there's going to be lots of choppiness around SpaceX, OpenAI, Anthropic, post-IPO. I think this is the start of an IPO wave.
And what could it mean later?
We are on the precipice of another fourth industrial revolution. These are very deliberate, capital-intensive, well-managed companies with visionary founders.
Fast forward to 2035, we should expect a majority of today's top 20 companies to be displaced.
We're not even at physical AI yet.
This should be interesting for investors.
The Money Talk Podcast, brought to you by TD Wealth with Kim Parlee.
Hi, everyone. I'm here with Michael Craig, Managing Director, Head of Asset Allocation and Derivatives. How are you?
Great, Kim. Pleasure to be here.
Nice to see you. And Kevin Hebner, Managing Director, Global Investment Strategy with TD Epic. Nice to see you.
Hey, great, Kim.
Okay, let's start with the topic du jour, du week, du month, I'll put it out there, is the SpaceX IPO. And the reason we want to talk about this is, never has one event, I think, triggered so many different conversations. So let me just start with the basics for people who don't know. What is SpaceX? What are they actually IPOing? And how on earth do you evaluate a company that has interplanetary travel and life as part of their prospectus?
So it is a complex company. So part of it is launch. And so Elon Musk launches rockets, and he's been doing that for about 2 decades. And right now they're launching a rocket every other day. So there's a lot. A second part of it is communication, so satellites. So they launch a lot of satellites. And roughly they have about 10,000 satellites, 10 million subscribers, 10 billion of revenues. And this is pretty interesting, but this could easily be 10x, say in 2030. So
that's the Starlink service.
The Starlink, yeah.
Starlink.
Yeah.
And so there's a lot of upside.
I love it,
to
but
that.
anyway, yeah.
And then in terms of the S1 filing from SpaceX, they think that about 90% of the value of the company actually comes from AI, and that can mean lots of different things, including orbital data centers, so solar stationary, essentially server racks in space.
Starship is their next generation of spaceship. It's about 36 stories high, if you can think about it. So if you're in a building right now and you're 20 stories in the air, you're not quite a little more than halfway through the ship. And if you're a Starlink customer, I mean, it is pretty phenomenal, and they've got ambitions to go into cell phones and whatnot. So, it's space, so it's kind of the ultimate frontier and endless. Has very much grabbed investors' imaginations.
Yeah, it really has. And I think, I'm a big nerd, so I love this stuff, and it's incredible what he's created. What's going to happen, or what do you think is, you've been, I know, talking to lots of people, you both talk to lots of people, what's the appetite for this when it actually comes to market? And then I want you to explain what, I guess, technically happens when it comes to market, because this is the largest IPO ever.
So appetite's going to be pretty big. On the institutional side, they have started the roadshow. They've been flying people down to Texas to take a look at the facilities. People are very excited. Musk is the master of memes, so there's going to be enormous appetite for that as well. So I think it's reasonable to believe maybe June 11th that we actually have the listing, so it starts to trade on the 12th, on the Friday. That first day we could get a pop, which is sort of normal for an IPO like this.
And then the lockup, shares the float, the rest of the float gets out there, and then it becomes massive.
We're only doing 5% of the total float. The challenge with a security like this, no traditional valuation metric is going to make any sense whatsoever. So Starlink makes money. That's the cash cow. They're burning cash. It's a very capital-intensive business, if you can imagine. And it really is about the optionality. And that
optionality, sorry, just in terms of the other industries.
Well, so in our conversation, SpaceX is about 10 years ahead of the nearest competitor. So they have in terms of private enterprise, they have a monopoly on space. So that's interesting. 10 years isn't forever, but it's a pretty big head start. And then the question is what is it they can actually deliver and build? And is this like a completely new asset class and this is just the early days, and that's the option. And when you think about options, There's there's the time, how much time you have to exercise an option. What's the volatility of outcomes? And is that shifting? And this, I think, to Kevin's point, on the first few days, I would assume you're going to have some pretty wild price action because they actually look at how options price. They can be quite volatile because they've got multiple drivers. There's the volatility element that can shift around people's imaginations, what have you. So I would expect to see some pretty wild turnings. It's a small float stock, so even though the company will probably end up with somewhere between $1.5 to $2 trillion valuation, only 5% of that will actually be available to public. And so it'll be an interesting week and a few months after as price discovery takes hold. But even with lots of price discovery, it's really hard to kind of pin down what the future looks like when the outcomes are so wide.
And price discovery will be noisy because of the demand as it goes in indices, and all the indices are going to want this in.
Can you explain just the indice action though too? Because of how will it get included? Will it crowd things out? I mean, I had heard anecdotally from someone I was speaking to that the communication sub-indice is going to be Starlink. It's just going to be Starlink. Practically, it'll crowd other things out. So how does that affect what's happening with the indices?
So there's a lot of different indices. So NASDAQ is the one that seems to be most flexible and willing to bend their rules. S&P's changing their rules. MSCI is doing it as well. So they all want this to some level, maybe 3x the float in terms of the representation index. But that does mean that passive money will come in. And maybe it's new money coming into markets. Maybe it's money that moves out of NVIDIA and other companies. So you've got the index part, I think, clouding price discovery. And then at the same time, you're going to have a lot of insiders who are vesting, lockups ending, and they're going to want to sell. So Tesla initially had a fairly small free float. Its free float now is 75%. And so I think it's reasonable to think that we'll be going to a number like 75% free float over time. And just to make things even more confusing, prediction markets think a year from now, there's a 50% chance Tesla gets merged in with SpaceX. So there's a lot going on here.
It's mind-boggling.
You keeping up, Kim? You got all that?
No, well, I feel every time you say a word, I have another question. So you said the rules.
Yes.
With the indice stuff. So I mean, from what I've read, there's pieces about profitability being suspended. Maybe there's some governance that's being suspended. And how material is that?
S&P will take some time.
Yeah.
NASDAQ, they've got fast entry rules. So if SpaceX is trading at a north of $1 trillion valuation, it's going to be in the NASDAQ within about 30 days. Yeah. Maximum. You got, call it $1 trillion following the NASDAQ at a $1 trillion valuation. That will get to about a 3-4% weight of the index. So, 4% on a trillion, that's $40 billion of passive flow that will have to go into the very small piece that's available. Yeah. So that's how you can see the mechanics start to really create demand. And obviously there'll be sellers. So those companies that are leaving or becoming reduced in terms of the NASDAQ will see some pressure on the margin, although it'll be dispersed across a lot of different companies.
And then on top of that, this SpaceX is the first one, and huge economy. But you've also got the other IPOs that are coming. You've got OpenAI, Anthropic. I know ByteDance coming out as well too. So, is everything now going to be kind of AI-driven, tech-driven? You can't help but be overweight tech now in everything. Is that just is that just a reflection of where the economy is now too?
So broadly in capital markets, whether it's investment grade or VC money, so AI is taking a majority of the capital. And so there will be a lot of IPOs, but we've really had very few IPOs the last few years. We've had about 25 a year on average. The late 90s were averaging 250 a year. They were smaller and they were newer companies. But there's a lot of room for the market, I think, to digest a lot more IPO activity than we've been seeing. And there's a lot of companies, particularly as AI moves to a more capital-intensive, more physical AI phase, they need a lot of dollars. And we're seeing even the big hyperscalers starting to go negative free cash flow. So they need a lot of money. And I think this is the start of an IPO wave. We'll have OpenAI, say in September, it'll be something like $900 billion to $1 trillion. We're very skeptical about this one because it's a company that doesn't have a clear product, doesn't have clear moats, doesn't seem to have a clear strategy, and somehow gets $1 billion or $1 trillion valuation. And then Anthropic, maybe in December, I think that's an easier company to understand because it has a real product, a real strategy.
They actually just finished a funding round, 65 billion,
Yeah.
giving it about 965 market
Okay.
capitalization.
Yeah.
So still demand in
Yeah.
private, and that's a big ticket.
Yeah.
65 billion on
Yeah.
a funding round.
And
Yeah.
all three of these companies will go into the global top 20 of tech companies that we've been talking. So it's a very big deal. And one metric we've been discussing is we've talked a lot about the Meg 7 over the last year or so. If you include these three, it's the Meg 10. And the market cap of the Meg 10 will be a number somewhere between 25 and 28 trillion. That's going to be greater than the market cap of the rest of the world equities ex-US. It's a really big number, sort of enormous market concentration.
How is this? I mean, just to get to the bottom line, I think there's two schools of thought. This is either, the harbinger of new industries, new economies, new everything, or it's a harbinger of a huge bubble.
Yeah, I think the bubble, it may end up as a bubble, but I think to be dismissive of it is like, you kind of sticking your head in the sand. I mean, we are on the precipice of the fourth industrial revolution, general purpose technology. It is finding its way throughout industry. I think a year ago, there was a belief that we were over providing compute. I think now the general consensus is we don't have enough compute. And it's going to find it. We're in the early days of kind of AI on my phone or digital AI. We're not even at physical AI yet. I mean, that's still.
Did you see the robot on the line?
Yes.
Who's sorting and picking packages?
Yeah,
it was amazing.
Yeah.
It's amazing.
But that's like,
I know the
it's
basic
early.
physical eye.
So
yeah.
is there a risk, like much like with the .com boom?
Yeah.
As this kind of progressed, you had more kind of marginal companies that kind of associated themselves with the internet, but didn't really have any business plan. And maybe we get to a point in time where you've got kind of .ai and it's some kind of half-baked idea that gets a $1 trillion valuation. But I think what Kevin and I are talking about with OpenAI aside, and sometimes you have these companies, OpenAI was set up as like a nonprofit, kind of an accidental lab, and they've kind of stumbled on a pretty cool idea. And the reality is it's still quite impressive. Whereas Anthropic and SpaceX is not a new company. But these are very deliberate, capital intensive, well-managed companies with visionary founders who are looking for great things. Now, do they succeed or not? I don't know, but they are real. There's no question that these aren't kind of half-baked ideas. These are real companies that need real investment. And as you kind of look at where capital is flowing right now, it's to feed this platform. I think that's going to be the basis of civilization for years to come. So not a bubble yet. We talk about this all the time because we're concerned about it. And even today, valuations are a little bit elevated, but nowhere near bubble territory.
Yeah, and with your question, you asked, are we creating new companies, new sectors, or a bubble? And I think that's sort of a false dichotomy. We're definitely creating new companies, new sectors. Now, that's always the case when you have a tech wave, is the bulk of value creation is in companies and sectors, industries that did not exist before. And there's very much a focus now on using AI to make us a little bit more efficient at the stuff that we're already doing. That's never where value comes from, as Michael was saying with the GPT. It's brand new things. So space as an industry and what that's going to evolve, humanoid robots at home, industrial robots at work, that's likely to be the biggest industry ever. It's not going to be the biggest industry ever next year, probably, I don't think, until 2045. Some people think earlier. But that will be very big. Autonomous vehicles, 1% of miles driven will be autonomous vehicles in 2032, 10% in 2040, 90% in 2060. So we are getting entirely new sectors, industries, and lots of new firms coming from this.
And it cannot be understated, the impact on science.
Yeah.
Like if you're a scientist today with AI, oh my God, like what you can do in days would have taken an entire multiple careers to accomplish. And so on top of it is you have the prospects for major scientific discovery with this technology. So, it would be foolish to try and tell you what it's going to look like other than this. And that gets back to the concept about SpaceX being this big option. Because if you actually think about the outcomes, you can make your head spin. And that's, I think, what investors are going to buy is the optionality of that company.
So, but how do you evaluate the optionality? How do you We were talking about this before we started. How do you evaluate good? How do you evaluate quality? Like, what does that mean? Because I think I saw a stat today, and I don't remember who put it out, but something to the effect is that the hyperscalers or some AI investment is not expected to return before 2030. No profits before 2030. And saying it almost as though that's accepted.
Yep.
So there's just like the fundamentals are changing. And so,
Yeah.
but how do you evaluate the fundamentals?
Well, growth is always a tricky concept for analysts to understand because hypergrowth has it's a curve. It's nonlinear, and ultimately it's you're paying for that nonlinearity, not much cash today. You're paying for the future profits. In terms of portfolios, you always kind of mix into growth, stability, income, and on the growth side, this is where you're getting growth. Sometimes you want expanding top line that's going at an exponential rate because that gets reflected in the valuation. There is higher default risk though with these things, but that's ultimately what you're buying into in a growth company is you're expecting much higher returns and you're taking at a risk of total loss. And from that, then it becomes the art is, well, what is the right company? Do you want to buy all of these in a passive approach, or do you want to be selective? And that's where scale and networks, personal networks, kind of come into play, where you can call experts and understand, like, is the technology evolving, or is it starting to be passed by others? And there's a informal group of people. If you're a technology analyst or a semis analyst, you'll have an informal group of people you can reach out to see what is the truth, because they can't really go and
the
ask
truth is being defined somewhere.
But it also comes out in those conversations and those networks and understanding what the beliefs are out there.
Yeah, when we're thinking about quality tech, often we're looking at a company and we're looking at its return on invested capital and how that compares to its cost of capital. Yeah. And the trick is the return on invested capital has a lot more persistence than people think. So if you're a great company, you stay a great company. And so that's a good way to screen for quality tech. The problem is if you have a disruptive new technology like AI, digital tech broadly, then we're going to have this notion of quality tech. And is looking backward necessarily a great forecaster of looking forward. And what we've been finding is quality tech is sort of delivering on what it's supposed to doing. So if you have a high return on invested capital, good margins, lots of free cash flow generation, you're doing well. But what's happening is the lower quintile of quality, so companies that don't have those characteristics but have a lot of optionality, are doing really well. So people are looking forward. There's a lot of speculation. In some cases, there's hype involved, and those companies are doing well. So we have the best performing factor year to date being momentum. And so that's what's challenging for investors who use quality tech. So if you want a more forward-looking measure, you can still be focused on return invested capital, but I think you have to be adjusting your measures for how the technology is moving going forward. And as Michael was changing, these growth forecasts, free cash flow forecast and return invested capital, it's really challenging.
Yeah.
Mm-hmm. It almost requires a degree of imagination and risk management. There's it's not all because, like I said, you really don't know what threats these things will bring to incumbents and how it's going to play out. Sometimes the best idea is you have 3 or 4 or 5 companies that you've done your work on. Maybe 3 go up a lot, 1 struggles, 1 falls off, but the overall portfolio is quite positive. So you can also apply portfolio theory just to spread around your risk when looking at these things. What a lot of investors sometimes do is they put it all on black or all on red 32. That's a roulette number for those who are listening. And if it hits, they look like heroes, but there's a 31 and 32 chance it's going to go to 0.
Right.
Which is the wrong way to think about it. And that optionality argument is very important right now when looking at capital markets.
I know. I was going to say one thing. Kevin, I know when you and I've talked before, you've got this list of top 20 global tech companies to look at, and a bit of a history, I guess. Like, is there a lesson from the history that we can apply somewhat in terms of going forward? Yeah. I'm not going to give away the whole thing, but list them all. But the top 5, you've got in January of 2000, Microsoft, NTT Docomo, Cisco, Intel, and Nokia. And then in January of 2015, it shifts to Apple's number 1, then Microsoft, Intel, AT&T, and Meta. And then April 2026, NVIDIA, Apple, Google, Microsoft, and Amazon. Microsoft does get the crown for being in all of them, although in a deteriorating position. Yeah. But I think the point you're trying to say when you look at the full list is it's almost completely different.
Yeah. So from comparing the list now to 2000, there's Microsoft, and that's about it in the list. But even if you compare it to 10 years ago, about half of the companies have been off the list. If you compared it to October of last year, you've had, because of the SaaSpocalypse, the challenges in the software sector, you've had SAP, Adobe, Salesforce, and Palantir follow the list. And then with the 3 big IPOs this year, you're going to have 3 new companies coming in. So then if we fast forward to 2035, what should we expect? We should expect a majority of today's top 20 companies to be displaced by the new type of companies that we're expecting. And that's what normally happens when you have not just a disruptive tech wave, but almost any time in markets. They're very dynamic, and there's a lot more churn, I think, than people recognize.
Well, I was going to say, and maybe more dynamic and more volatile as we go forward, too.
And long-term prediction, and I won't be around for me to call me on it. I'm gonna predict that in 2035, those top 10, they're generally going to be physical capital.
Physical
capital.
Meaning?
Things. Robots, actuators, chips, things it's hard to touch a chip, but the point is real things versus what we've been through the last 10 years, which has been light capital structures, growing margins, limited CapEx, software. I think that we're going to shift back to the physical world, and that's where scarcity is. I think that's where demand's going to be, and that's where it's going to be really expensive. And hence you're going to see those types of companies in that list.
I think just to kind of maybe bring people up to a conversation we had before we started is that just that you're going to, all these things lead to demand. Everything has to power everything, and all the investment is very physical. And this is all going to have to translate into the economy in terms of a build. But maybe just tease that out for us to understand what that means, the implications of that.
So I think for most people through the 21st century, we have been in a world where there has been excess savings. It was one of the reasons we had the financial crisis. It was one of the reasons that we lived in for 10 years or 7 years of quantitative easing, very depressed bond yields, which has led to elevated valuations of other assets. Certainly real estate in many jurisdictions has been bid up because of that. I think it's becoming rather obvious that we are now reverting where the price of capital is going higher. And I think there's going to be a demand for capital much greater than what we've seen in the past. Governments are already running large deficits. Industry is now making large investments. There is remilitarization campaigns in the West. There is a push for greater infrastructure build out in the West. All cost money. And so where is it going to come from? And so this isn't necessarily a good thing or a bad thing. It's just that we're shifting from the savings glut to almost an investment glut, if you will. And that is something for investors to be wary of. I mean, I think it's important. You don't have to just go and buy because everything is going up. You can be a bit more selective as capital demand increases, and with this, there'll be winners and losers. It's making sure your company has access to financing is more important today than it was 10 years ago.
So the market's been dominated by capital-light companies that generate a lot of free cash flow. And as Michael was saying, we're moving into a world in which physical AI, physical companies going from the world of bits to the world of atoms. So companies, we've been talking about autonomous vehicles, drones, robotics in space will become important. And upstream from them, batteries, actuators, sensors, and so on. And then upstream from that, steel, aluminum, critical minerals, and so on. So it's going to be a much more capital-heavy world, and so a lot more demand for capital, less free cash flow generation with that. And I totally agree with Michael. In 2035, should have us back on the show. And I think the list of top 20 companies
I'm
at that
going to
time
look the same thanks to AI and everything. But go ahead, yes.
Will be quite heavy on the physical AI and physical side.
And what's interesting about this IPO cycle is, for years, the stock of companies has been shrinking. There's been stock buyback and stock buyback, and so it's been shrinking. And now we're starting to turn the engines the other way and are now issuing stock. So again, a very different world. We talked about buyback yield. Well, maybe you want companies to be investing that capital in this world of investment. That's how we're going to shift our focus, not so much how much I'm going to get back from a company every month, but I want you to go invest that, because if you don't keep up, and build out your own AI within your company, you're not going to be relevant in rather short order. So, again, this is the shifting mindset I think that people need to be aware of when investing.
I'm going to try and challenge something, and you guys can both. I know you'll tell me I'm wrong if I do, so I'm not worried. But there's an assumption there that there's going to be that the physical is going to need to feed all the intelligence. I'll just say the intelligence in the new frontiers. But why isn't there to say there won't be just as many step changes in physical? Like, we go from fission to fusion. We find, I don't know, like new nano materials, new things. Like, all these things can happen, but where it reduces the demand maybe for those things.
I think you've been reading science fiction. You're on the.
I'm on that. Yeah.
We've got a new element.
Yeah, but it could, but that happens, right?
Periodic table is pretty fixed.
Yeah.
And we don't. Material science is always moving, but if you think about the speed of how fast Moore's law has applied, it does not apply to batteries, right? Chemistry is much more challenging. So it's possible, for sure. And as with scarcity becomes efficiency, that's when we start to innovate. But it moves slower than in the digital world. Would be my pushback.
I also want to mention a bit, because we've been talking a lot about IPOs, and there's a bit of concern from investors we speak with that if you buy an IPO, it immediately drops after first day trading. And there are some examples of that. The last great big IPO, Aramco, late 2019, it's underperformed by 50%. But on average, if you're a VC-backed IPO, on average, you underperform by 1% per year with an enormous dispersion. And certainly there's going to be lots of choppiness around SpaceX, OpenAI, Anthropic, post-IPO. But on average, these are not stocks that are doomed to underperform. And people, as Mike was saying, the number of companies that have traded has been declining as more companies go private. But this should be interesting for investors.
I had another conversation with one of your colleagues recently too, and this might just be where we're pulling forward demand and things, but it was interesting because it showed GDP kind of up and to the right, very slow and steady. I don't know what that would say, 1-2%, and earnings just going way up above it. And just so, does GDP rise to match earnings, or do earnings fall to match GDP, or is that just something that doesn't matter in this conversation?
Tough one. I would think that nominal GDP accelerates to start to, over time they tend to converge, but it's really nominal GDP that matters because you got to include the inflation component. But candidly, GDP hasn't been a great measure for revenues. There's a school of thought that it should be. But if you looked at GDP over the last 15 years, you probably would never bought the U.S. market. It hasn't been ripping, but the market's been doing quite well. So I'm a little bit skeptical of that relationship.
Okay.
GDP is great for measuring investments in capital investments in groceries and gas bills and whatnot.
But not for innovation and not for...
No, and ultimately what I think Kevin would argue, I'm going to let you argue, but I'll argue.
We keep telling you what you're going to say, and then you get to say it.
Is that when we look back, and we can only look at this looking forward, it's going to be, what does productivity look like? And if you do see a lift in productivity, then valuations will be fine. That'll justify a re-rating of the market. But you only know it till it's after it's passed.
And we've been in an environment, this sort of capital light, lots of free cash flow generation environment that's been great for shareholders, owners of capital. It's not been great for labor, and this is a so-called K-shaped economy. And it looks like that is going to continue, though the pivot into a more capital-intensive, more physical economy, I think it does bode well for a number of skills, like skilled tradespeople should do very well. But to benefit from AI, whether it's AI-first software companies or physical AI companies, people are going to need skills, either skills like being electricians and so forth, or university training. And people who don't have the skills and the ability to learn, it's going to be a challenging world for them. So my guess is this K-shape does continue, and it continues to be quite a good world for owners of capital.
Which has been the theme and continues to be. Then you get social instability that can happen later on. Another question, I guess, would just be like the blowback from AI and the K-shaped economy too. So how does that play into, because physical AI is physical, I'll just say, is exciting. The definition of quality, interesting, optionality, what that means, how you define it. But the red flags,
Yeah.
is if I have here, energy prices, jobs, campaigns against AI, campaigns with mental health. Like, how does that all play in?
So AI is even less popular than Congress in the States. I'm based in New York.
Yeah.
That's pretty bad. But there will be no regulation at the federal level. There's lots of regulation at the state level. And there was an executive order on Trump's desk last week. He did not sign it. He's very close with the tech industry, and David Sachs's AI czar pushed back very hard on this. And part of this is the view that there is this geopolitical competition, an AI race against China, and especially in physical AI, that China is well ahead of the United States. There's some areas where the US is ahead in semiconductors and in space, thanks to Elon Musk, it's ahead, but many areas that it's behind. But the view that the US can't do anything to slow down the progress, and Trump's number one economic priority, increasing the industrial capacity of the U.S., and number two, keeping up with China, winning the AI race. So,
What does winning the AI race mean?
It's a good question.
So, I think it does sort of have a meaning. In the first industrial revolution, England won. And it supplanted the Netherlands and France, and then England ruled the world for the next century. The second industrial revolution, the United States won. Germany came second, and we'd probably be in quite a different world if Germany had come first. And Germany did lead in many sectors even after that. Rockets, for example, chemistry, Germany led. But because the US won, and that they defined the world for the next 150 years, say from 1870 or so forth. So the best outcome right now is that we don't get a clear winner. It's sort of a tie, and this is the best thing for stability. But we have two countries that are competing, non-kinetic competition, but no one's dominating, no one's imposing their will on the world as a whole. So that's the best outcome.
We have kinetic stalemates going on around the world, I would say. But I mean, no, I know. I
But
get your
not
point,
directly
But the challenge is if one
countries,
starts to get an advantage, then the risk is that they use that for leverage over the other,
Yeah.
and that's where you get.
Yeah.
It's going to be a bit more hostile.
Yeah. We're up against the clock, so I want to ask you, the goal was to kind of help us understand the IPOs, help us understand SpaceX. What should investors take from this, I would say, over the next 6 months? What's happening, and what should they keep in mind?
Well, if you're really interested, read the S1. It's out there. It's public.
It's fascinating.
It is fascinating, especially if you like science fiction. I think looking at it from, I'm not going to get I used to be an option trader, so it has stuck with me, but you have to really think about this as not in traditional, and be aware of the traditional valuation markets, but be aware of the optionality of new industry and disruptive industry. And you don't want to overpay for that, but by God, you want to have, it's a very useful thing in a portfolio to have optionality. And third, look for the warning signs. If, again, we would argue that it's not at a bubble, but if, you start to see some kind of ridiculous companies coming to market with really no, concept stocks, if you will.
Or if Elon Musk gets a cough.
Anyway. Yeah, no, I wouldn't worry too much about Elon coughing, but if you get, when you start seeing, look, there is an element of a little bit of the Wild West right now in the U.S. market, and certainly regulations have been peeled back, and there's benefits and costs to that. But if you start to see bad actors, that would be a red flag to watch out for. I don't think we're there yet, but that'd be something I'm on the lookout for in terms of.
Yeah, Elon Musk does turn 55 this month, but he seems to be in pretty good health. He's certainly trying to take very good care of himself. I sort of view it as we want this sort of barbell structure, exposure to tech, and I like to have a quality bet, but we can debate what quality means.
We're starting the conversation.
And then the other part of the barbell is real assets, so commodities, infrastructure, and then equity markets that are exposed to that, which would include EM. There's a lot of commodities. There's also a lot of tech, and it's cheap.
Yep.
And then also Canadian assets, Canadian equities. There's lots of real assets in that, Canadian infrastructure. And overall, I think the Canadian dollar looks well posed. And we're pretty constructive, I think, on Prime Minister Carney's policy outlook and the things that he's trying to do. I think there's a real pressure on him to start getting things done. But we're positive on that, and we think it looks good for Canadian assets.
This is a dangerous question to finish with, but I'm going to do it anyway, and I'm going to give you the last word, so you get to listen to Kevin first. What have I not asked you that I should ask you?
We've gone through a lot of things.
This will be the first time if you say nothing. So it's,
I think the only thing is when we're talking about the risk, I think the big risk for markets is a liquidity squeeze from central banks making a policy error that is hiking because of concerns that oil will result in inflation that gets sticky and gets embedded in prices. I think that's a very wrong way to read the economy. It looks like the ECB is making that mistake, but the impact of oil, let's say like 4% of US GDP, it's pretty small. It's $90. It's not too far out of the range. I think central banks just sit back and let that pass through. But if you do get central banks hiking, and then we get a lot of liquidity to take on the markets, I think that's the biggest risk we're facing.
Michael?
I think there are, if you think about financial markets, it's complex systems, which I do. We're pushing much different levers on that system today than we would have, say, 5-6 years ago. We're having shifting priorities at the national level and governments. And I just sometimes wonder, what is the true fragility of the system because of all these various pressures? And that could be positive or negative. You could have all of a sudden parabolic moves in the market or really unanticipated inflation. So I think that we've had a thesis for a long time that we're in much more of a boom-bust backdrop than one of just kind of meandering nowhere, which is the 2010s. Boom-bust means booms and busts. You have markets that go really hard, and then you have periods of bust, and that cycle I think is moving faster than what we've been accustomed to in our careers.
And we've seen it already begin compared to the past.
You've already had one rally, one cycle of this in this decade, and I don't think we're done yet. So that would be the one thing I think about is fragility of markets, and then just moving back to that boom bust, overinvestment, inflation, resource scarcity world that we're in today.
All right. Well, thank you both. I'll have you back before 2035, so we'll do that. But thanks so much.
Yeah, thanks, Gary.
Our pleasure.
Thanks for tuning in to this episode of the Money Talk Podcast, brought to you by TD Wealth, recorded on May 28th, 2026. The information contained herein has been provided by TD Wealth and is for information purposes only. The information has been drawn from sources believed to be reliable. The information does not provide financial, legal, tax, or investment advice. Particular investment, tax, or trading strategies should be evaluated relative to each individual's objectives and risk tolerance. The views expressed are those of Kevin Hebner, Managing Director, Global Investment Strategist, TD Epic, and Michael Craig, Managing Director, Head of Asset Allocation and Derivatives, TD Asset Management, as of May 28th, 2026, and are subject to change based on market and other conditions. Certain statements in this presentation may contain forward-looking statements that are predictive in nature and may include words such as expects, anticipates, intends, believes, estimates, and similar forward-looking expressions or negative versions thereof. Forward-looking statements are based on current expectations and projections about future general economic, political, and relevant market factors, such as interest and foreign exchange rates, equity and capital markets, the general business environment, assuming no changes to tax or other laws or government regulation or catastrophic events. Expectations and projections about future events are inherently subject to risks and uncertainties which may be unforeseeable. Such expectations and projections may be incorrect in the future. Forward-looking statements are not guarantees of future performance. Actual events could differ materially from those expressed or implied in any forward-looking statements. A number of important factors, including those factors set out above, can contribute to these digressions. You should avoid placing any reliance on forward-looking statements. Information about specific companies or securities, including whether they are profitable or not, is provided for discussion purposes only and is not endorsed by TD Wealth, the Toronto Dominion Bank, or its affiliates and related entities. Any reference to a specific company listed herein does not constitute a recommendation to buy, sell, or hold securities of such company, nor does it constitute a recommendation to invest directly in any such company. TD Wealth represents the products and services offered by TD Waterhouse Canada, TD Wealth Private Banking, offered by the Toronto Dominion Bank, and TD Wealth Private Trust, offered by the Canada Trust Company. TD Asset Management is a wholly owned subsidiary of the Toronto Dominion Bank. Epic Investment Partners, TD Epic, is a wholly owned subsidiary of the Toronto Dominion Bank and an affiliate of TD Asset Management. The TD logo and other TD trademarks are the property of the Toronto Dominion Bank or its subsidiaries.